Hey, what's going on everyone? It's Griffin here and I hope you're all having a great day as always. Now, as you can see, I'm in a pretty blindingly white and bare space here, but this is temporary. Over the past couple of days, I've been moving into a new house that I purchased and I've been setting up this new office studio. By the way, if you haven't already checked out my previous video on the house, then make sure to check it out after watching this video. But yeah, I'm still waiting on some furniture to be delivered for this studio. Behind me, I'm probably gonna have a nice bookshelf, a plant here. Obviously, I brought back the jade plant, which has kind of become famous on the channel, but everything just to make this a nice office studio for the audience when you're all watching my videos. So anyways, I took a little break from posting over the past week because I've been busy with renovations, but I'm back today with a new video going over 2 TSX listed dividend stocks to include in your portfolio in 2021. This is a topic I wanted to revisit for investors who may be newer viewers to my channel and who are looking to build a portfolio of solid dividend stocks as well as exchange traded funds in order to create long-term wealth in the value of their portfolio while also creating some consistent dividend growth over time. It's really easy to get caught up in always looking for the next best growth stock that's going to create a short-term gain for you, but really I've been speaking about creating a portfolio that's broad and diverse before venturing on into higher risk positions. I'm speaking about quality dividend stocks like we're going to be speaking about in today's video, as well as exchange traded funds that are going to act as a solid core to your portfolio for appreciation over time. And then once you have built out that more solid portfolio, you can then go ahead and venture on into riskier positions. In fact, I recently made a video going over 4 other great dividend stocks to include in your portfolio, including TELUS, Enbridge, Medical Properties Trust, as well as Algonquin Power. Those are really great dividend stocks to hold in your portfolio, so definitely make sure to check out that video as well if you're looking to grow your dividend portfolio in 2021 after watching this one. I really hope you enjoyed today's video. If you do, make sure to drop a like. It really helps the channel out, and also make sure to check out the links down below to open up a new brokerage account if you're new to investing and you want $25 for free with Wealthsimple Trade when you fund and deposit $100 into your account. Alright, so even though this is a dividend growth stock pick video, my channel really focuses on also allowing you to understand what you're looking for when analyzing your own investments. So I want to first go over a couple things to look out for a quality dividend stock before we jump into the first pick here. First of all, for a company to comfortably distribute and continue raising their dividend payments over time, it's really important that the company you're looking at is financially sound from an income statement and balance sheet standpoint. What I mean by this is consistency and regular increases in revenue, as well as a healthy bottom line figure, which is their net income. And the reason for this is because for a company to consistently redistribute a portion of their earnings, typically they're going to pay out a dividend distribution to shareholders after their retained earnings, meaning keeping a portion of their net income for funding other areas of their business, and then what's left over they're going to then use to distribute dividends out to shareholders. So it's really important that they see a consistent increase in revenues as well as a healthy bottom line figure. And with this in mind, there's also a ratio that dividend investors tend to look at when analyzing a new dividend stock known as the dividend payout ratio. And this is essentially a ratio comparing the amount in dollars that the company is paying out to shareholders as dividend distributions in relation to the company's bottom line, which is the net income. For example, Algonquin Power, which we spoke about earlier, is a dividend stock that I personally hold in my portfolio, and it currently has a dividend payout ratio of 73.11% based on the trailing 12 months of earnings. Generally, I like companies with a payout ratio below the 60% range, but in today's market environment, a lot of companies are seeing a higher figure because they are generating lower net income. So yeah, especially considering the current state of the economy and the stock market, just make sure you're looking for quality dividend stocks that show resilience in their business operations while also showing nice and healthy financial figures in their income statement and balance sheet. So with that said, let's now get into the first pick for today's video. Alright, so the first stock we'll be covering is called Capital Power Corp, ticker CPX on the Toronto Stock Exchange, and as the name of this company would suggest, this is a power generation company that develops and operates power generation facilities. CPX is essentially a utilities company, and you're going to notice here across my TSX dividend stock videos that typically these companies are going to operate in one of four industries, being either the banking/financial industry, real estate industry, telecommunications, or the utility/energy industry. In Canada, we honestly don't have that many stocks to choose from, and in relation to dividend stocks, these are really the four main industries that are known for paying out healthy and consistent dividends. Speaking of dividend growth, CPX is in fact a Canadian dividend aristocrat at now 7 consecutive years of consistent dividend payments and growth at an average annual increase of 7%, which is very nice. And in 2021, the company is once again on track to continue increasing their dividend payments by another 7%. The dividend yield itself is also on the higher end of the utility space at 5.38% as of last night's market close, and this places the company's dividend payout ratio at 78.41%. Again, that's a bit on the higher side, but considering that the company pays out roughly $63 million per quarter in dividends and has $130 million in cash as of the last quarter, this isn't necessarily something that worries me regarding dividends moving forward. Now, let's speak a bit about this company's income over the past couple of years in relation to their business model. So as mentioned earlier, CPX is a utility company, and the beauty here is that they have long-term power purchase agreements in place that generate more predictable revenues, even though revenue growth won't look anything like that of a growth stock, which is okay though, because in this case, we're after stability and increases in dividend payments for a quality dividend stock. This makes the company more resilient to market and economic shifts because they can count on a certain level of income coming in, right? If we look at their income growth over the past couple of years, we can see steady increases, and the company is on track to continue this trend for the 2020 calendar year. This is the same concept that I spoke about in my recent video covering Algonquin Powers, where having regulated utilities allows them to have consistency in their income. Another element I want to focus in on for this company is the operating cash flow, which for CPX is generally very high as they can depreciate their massive fleet of utility assets and then reinvest a huge portion of this back into capital expenditure, also known as CapEx, which is money being spent on more assets. And the bottom line is that this company is able to create nice free cash flow figures. Quickly looking over their balance sheet, Capital Power does have a couple of red flags, I'll be honest. First one being that their current debt is quite high in relation to total current assets, right? So total current assets of $929 million, but $1.352 billion in current liabilities. This places their current ratio at 0.69, which is significantly below what I usually target at above 1. Is this a huge problem? Well, for other companies, I would say yes, but for a utility company where it's normal for them to carry high levels of debt to fund their assets, I tend to let this slide for this company and other utilities, which pretty much all have current ratios below 1. And speaking of total assets, CPX has $8.9 billion in total assets, mostly comprised of gross property and plant, which is completely normal for this type of company that has a massive fleet of assets for generating and distributing these utilities. Their total ratio is 1.51, which is completely tolerable. All right, and finally, let's take a look at the stock quote and some of their ratios. So the stock is trading at around $38.18 per share, which has run quite substantially actually since March lows and is now trading basically at all-time highs. So do expect some price fluctuation if getting in around right now. But with that said, this is very much a dividend play, and long-term, I see this as being a winning position. Assets remain cheap at a price to book ratio of 1.96. Their trailing 12 months price to earnings is 15.54, and then forward PE is expected to actually increase quite a bit at the new share price reaching 19.19. Comparing this though to industry peers like Enbridge, Emera, or even Canadian Utilities, the value is right in line or even undervalued in relation to the industry while boasting one of the highest yields. So all in all, I believe CPX is a great dividend growth stock to add to your dividend portfolio in 2021 for some nice portfolio income. Make sure to let me know down in the comments whether or not you've heard of this company and whether or not you're looking to include it in your dividend portfolio. Also, while you're down there, make sure to smash the like button if you're enjoying today's video. Moving on now to the second TSX listed dividend growth stock that we're going to be covering today. This is a company that I have spoken about previously on the channel. It is Fortis Incorporated, ticker FTS on both the TSX as well as the New York Stock Exchange. I'm bringing this company back up again for a couple of reasons, because this is a stock that for anyone who's new to my channel in the past 6 months, who's looking for solid dividend stocks to add to their portfolio, Fortis Incorporated is one of the best Canadian picks for a couple of reasons that we're going to be looking over right now. First of all, Fortis Incorporated is a leading utilities provider all across North America, and they have multiple different facets to their business, including regulated power generation, electricity transmission, and then also energy distribution all across Canada, the US, as well as some Caribbean countries. Now, the US market accounts for roughly 60% of this company's total income, even though this is a Canadian company. And let's keep in mind here that around 99% of Fortis's total revenues are regulated from regulated utilities, meaning that they're able to generate more consistent and steady income, which allows them to achieve things like 47 years of consistent dividend payouts and increases. Fortis is actually one of Canada's longest standing dividend aristocrats, and they now even use this as one of their main attractive elements to entice dividend investors, which is fine because their business is strong and their dividend yield is currently 3.86% at the time of filming this video, making it a great dividend stock to hold long term in your Canadian dividend stock portfolio. Taking a quick look at their income statement, we can see that revenue growth is quite constant and steady, right? This isn't a growth stock by any means, and 99% of their revenue is regulated, but this figure is still growing, and actually they have managed to increase their bottom line though since 2016, with the trailing 12 months retracting back a little bit, which is absolutely not surprising considering how 2020 has panned out for most companies, and the utilities industry certainly was not immune. Moving on to their balance sheet, we have the typical utility stock balance sheet with quite a bit of current liabilities, placing their current ratio below 1, which again is quite common for utility companies as they carry a lot of debt to fund their massive asset pool. What's important with Fortis though is their total assets at 53.41 billion, which is a massive amount of utility assets, and their total liabilities are 35.658 billion, giving them a nice and healthy total ratio. All right, now finally, let's take a look at their stock quote and some of their ratios. So Fortis has a market capitalization of around 24.44 billion, making it a large cap Canadian utility stock. Now, in contrast to some other industry peers, the trailing 12 months price to earnings is a bit high at 19.74, but forward PE is in the 18 range, and as of right now, the stock is still trading roughly 10% below its peak from last February. Again, the company has managed to increase its dividends for the past 47 years, and they're projecting a 6% annual dividend growth rate over the next 5 years. So as a dividend investor, you can't really go wrong with Fortis, which also could provide some nice upside in share value as they continue to grow and expand their utility network. So that's going to wrap up today's video covering 2 TSX listed dividend growth stocks to add to your portfolio in 2021. Again, if you want some more great and solid picks, make sure to check out this video that I'm overlaying right here, going over 4 awesome dividend growth stocks that you can also add to your portfolio for some nice cash flow over the course of 2021. I really hope you enjoyed today's video. If you did, make sure to drop a like. It really helps the channel out, and also consider subscribing and hitting the bell button to be notified whenever I release new and upcoming investing content. Last but not least, if you're still new to investing, make sure to check out the links to the resources that I use and recommend down in the description for my investing, including my investing course, as well as some stock brokerages where you can get some free money for signing up and funding your account. So on that note, thanks a lot for watching today's video, and I'll see you in the next one.